you've got the loonie. Your currency is called the loonie, and it's called a loonie for a very good reason, quite frankly. This guy is a nutcase of the highest order. The grocery stores will eventually be empty, and you won't be able to buy anything in Canada. You'll have to go out fishing and hope you catch a walleye.
We're talking inflation, the government budget deficit, and the government shutdown that appears to be on the horizon with our next guest, esteemed economist Steve Hanke, professor of applied economics at Johns Hopkins University. Professor Hanke, always good to see you. Welcome back.
Great to see you, David, and great to be back also.
Inflation seems to be back. I'm talking about headline CPI. It's been, let's talk about headline first before we talk about today's core PCE release, which was 3.9% on an annualized basis, a little bit softer than the last print. Headline CPI has been rising for 2 months straight since the beginning of the summer, or middle of the summer rather. Was that due solely to the rise of the energy price? I'm talking about crude oil, or were there other factors involved?
Well, the oil price was a major element in that little uptick that we had with the headline CPI came in, 3.7%. That was 3.2% in July. The 3.7 was August, but that's not uncommon for these things to move around. Remember the forecast John Greenwood and I made based on the quantity theory of money, it was that we would end the year between 2 and 5%, and we will. I'm confident of that. It's pretty much a done story, a done deal, as they say at this point in time. What's interesting, though, is that you mentioned the numbers that came out today, the core PCE. The core PCE is down at 3.9. It went from 4.3 to 3.9. Well, no one's talking about that. It's very interesting. Everybody's whining around about the little pop-up we had from 3.2 to 3.7 and the headline, and then a number comes in that's good, indicating that, the inflation is coming down if you look at the core, and there's almost nothing being said about it. Also, I would add that another thing that actually leads all these things is a producer price index, and the producer price index is at 1.8. It's falling. So the producer price index falls first, then the consumer price index falls, and then the core lags behind. And of course, I'm not surprised that the core fell today because it lags behind the other ones, and the other ones are falling with the exception of that little blip in the headline. So the reason they're coming down, and they will come down next year, is that the money supply is contracting, and we all know that the money supply is the fuel that fuels the economy. The U.S. economy is running on fumes now. We've had the money supply actually contracting since April, and of last year, that is, and we know that with a lag, economic activity will slow down, and with another lag, prices will slow down. And so where are we? Greenwood and I have just made our forecast for 2024, looking ahead, and we range. We will have a recession in 2024. That's baked in the cake, and that is because months ago the money supply started contracting. It's still contracting at negative 3.7%, and that means economic activity will dump us into a recession. As far as inflation goes, we're looking at headline between 0 and 2%. This year, we said it would end at between 2 and 5%. Next year, it will end at between 0 and 1.
Well, that's below. Are you talking about headline? Sorry, Professor, you're talking about headline or core right now?
Headline.
Okay.
let me back up. Let me correct myself, David. The CPI 1 to 2%, 1 to 2%, 1 to 2%. I said zero. I misspoke. Headline CPI next year between 1 and 2%. So this headlines coming down throughout 2024, and we're going to be in a recession.
Do you have an outlook for the core PCE or CPI?
No.
No? Okay, stripping out food and energy. Yeah, it is volatile. Basically, what you're saying is we're looking at inflation at much lower levels than today, and perhaps even lower than the Fed's 2% target. If inflation does get below 2%, right, what's the Fed going to do? Cut rates?
Well, yeah. If that happens and simultaneously we are in a recession, the Fed will pivot. They'll stop quantitative tightening and they'll start reducing the Fed funds rate.
Well, then given that you think there's going to be a recession and given that your inflation outlook has been correct thus far, you're saying, I guess indirectly, that we're expecting a Fed pivot by next year. Right?
Yes, they will pivot sometime next year because the Fed, they have no theory of anything. They are data dependent. They're driven by data that are coming in day by day. So if they see the CPI down at 1%, they will be inclined to pivot. And if they see a recession and increasing unemployment, they will be tending towards a pivot too. So all of that is pivot data. That data dependency that they look at and they rely on, that will signal to them that they better pivot. But it'll be too late because all the data that they're looking at is lagging. The thing they should have been looking at is what in the world they were doing with the money supply all throughout this year. They haven't been looking at it. They're flying blind.
Okay. If the Fed pivots, is there a historical precedence that we can look at in terms of how much they will likely cut rates into a recession? What do they usually do in a recession? In the past, I believe it's something like 500 basis points towards the end of the cycle, right?
Well, it's a little hard to predict exactly what they'll do. The only thing I'm confident about, if we get the kind of data that I'm telling you, the quantity theory of money indicates we're going to get, they will pivot. That's all I know. And I'm confident that they will pivot. Exactly what they will do and so forth, I don't know. And honestly, I don't think anyone has a model for this because no one really has a very good model for the Fed because the Fed doesn't have a model. The Fed flies blind. So it's hard to tell what in the world the exact magnitude of a pivot would be.
Well, Professor Hanke, the labor market doesn't seem to be deteriorating significantly just yet. Just yesterday on Thursday, the initial claims data came out at 204,000 new jobless claims filed. That's slightly down from the 217,000 that we saw earlier in September. So no signs of a huge uptick in unemployment just yet. Unemployment right now is at 3.8%. I'm talking about U3 unemployment. It's slightly up from the previous month, but not significantly. It's still relatively low compared to historical levels. Don't we need to see unemployment tick up significantly before we can claim that there will be a recession?
No, the labor market lags way behind the economy. Economic activity goes first, and the last thing you want to do, think about it this way. What if you're, David Lynn report, you've got all your staff and everything, and business starts going south on you. Well, you don't fire people on your staff before business goes south or the economy goes south. That's the last thing you want to do because you've trained all these people, you're close to all these people. You've got a lot invested in them, and the last thing you want to do is to have to fire somebody, or even reduce the number of hours they're working per week. Now, that is one thing that is happening. If you look at the labor market, overtime has slowed down. hours worked is slowed down. It's softer than you think. I mean, you gave some numbers that were kind of, shall we say, headline kind of numbers. But if you look underneath the hood, the labor market is slowly unwinding and getting softer. And by the way, the labor market would be the last thing to go for the reasons that I just gave you. You don't want to fire somebody that's working for you. That's the last thing you want to do, and that's why the tenor of the labor market is a very lagging indicator. It comes after economic activity starts slowing way down and everything.
My question is, Professor, why hasn't economic activity slowed down at any considerable degree just yet? We're talking about next year. There's a slowdown, but the money supply has been contracting for a year now. Yeah.
Yeah. Well, the money supply changes, and it takes between 9 and 18 months for the economic activity to start taking into account what's been going on in the money supply. So it can be a year and a half. And that's what fools people, this data dependency thing, watching the data every day, watching the ticker every day. It's a fool's game, because in fact, what you're watching today is being caused by changes in the money supply that occurred maybe a year ago or maybe a year and a half ago. So it's a tricky business. But the trick is you got to watch the money supply. What was going on in the money supply in the past? And that's what people aren't watching. They're just watching all this stuff that's coming through today without thinking, what caused that? And what caused it was changes in the money supply. Remember, that is the fuel for the economy, the money supply. It's all about the money supply. But these lags are long and variable, and that's that. Even somebody like me, that you've got to be watching it very carefully and calibrating. And my view is that we're going to be kind of a long time this time between changes in the money supply and changes in economic activity, because we had this huge ballooning of excess savings during COVID. And those have now been burned off, by the way. Those are finally out of the system. So you ask, why is this thing taking so long? I think it's taken a little longer than normal because people had a little bit of savings in their pocket, and they were spending it and keeping the economy going. And now that excess savings that was accrued during COVID is burned out of the system.
Okay. Professor, why is it that you and Mr. Greenwood didn't project a deflation next year into a recession?
Well, because we didn't.
But what's stopping? Okay, let me rephrase the question. What's stopping the economy from going into deflation? If you look at the money supply, the M2 money has contracted, and this is this is not something that happens very often. In fact, the last time it's happened, I believe, was, correct me if I'm wrong, but before the around the same time of the Great Depression, right? Right after the Great Depression.
Right after. So it's been a long time ago, and going from where we are down to 1% is a pretty steep fall. That isn't deflation; it's disinflation. It's going down, and going down pretty significantly. As you pointed out, 1% is even a percentage point lower than the inflation target of the Fed at 1%. To hit the inflation target, by the way, what would the Fed really have to be doing over a sustained period of time? They'd have to hit Hanke's golden growth rate, which is all based on the quantity theory of money, and that's around 6%. They're contracting it at minus 3.7%. So 6% is a lot higher than what they're doing right now.
Here in Canada, I'll let you comment on this. The government has proposed that.
So Minister Champagne will be calling on the heads of large grocers to come to Ottawa with a plan to address the rising cost of food. And we expect to hear from them by Thanksgiving on what their plan is to stabilize prices. And if their plan doesn't provide real relief for the middle class and people working hard to join it, then we will take further action, and we are not ruling anything out, including tax measures.
Effectively, it's a price control method.
Yeah, it's a way to strong arm the grocery stores. This is a Trudeau purely nutty idea. I mean, the guy's fairly nutty anyway, but it's just one thing after another in Canada. I mean, you've got the loonie. Your currency is called the loonie, and it's called a loonie for a very good reason, quite frankly. This guy is a nutcase of the highest order. And by the way, this is just exactly what Macron has proposed to do in France. So I think Trudeau, maybe he's talking to Macron.
But why won't it work, Professor? Why? I mean, in theory, you tell the grocery stores, don't raise your prices or we'll tax you more. I mean, isn't that just going to fix price inflation?
No, it's going to mean that the grocery stores will eventually be empty and you won't be able to buy anything in Canada. You'll have to go out fishing and hope you catch a walleye.
Okay, for the layman watching this, can you explain why it is that price restrictions or a cap on prices will lead to a supply shortage?
Yeah, go back and read the history of the Soviet Union. You'll find out exactly how this works. If you put a price cap on something, and you put a price cap of $1 Canadian on whatever it happens to be, and it's costing the grocery store $1.20 to produce it, you think you think the supply is going to keep flowing into that grocery store? No, it's going to end up being zero. You'll have nothing on the shelf. That's what price controls do. They distort completely the economy, and at the extreme, in the example that I just gave, if you put a price cap on and the cost of producing and delivering something is greater than that price cap, no private individual will be willing to supply it, and you're going to go hungry. And if you don't catch a walleye, you're going to have to go out and shoot a moose or something.
Is that what happened with the Venezuelans? Because they also had similar policy?
Absolutely. There's no question about it. Absolutely.
Okay. So then what is the solution to, we want to see, look, we as citizens, anywhere we live, we want to see deflation. We want to see our prices come down, not just go up by 1%. We want to just go back to pre-COVID. Is that possible? And if so, what is the government policy needed?
It's very clear what has to be done, and that is that central banks with discretionary monetary policy have to figure out what rate of growth is consistent, what rate of growth in the money supply is consistent with hitting their inflation target. And in the U.S., I gave you, based on some little arithmetic with a quantity theory of money, that Hanke's golden growth rate is about 6% per annum. The broad money measure M2 in the United States, if it was growing at about 6%, would allow the Fed to hit its inflation target of 2%. I've got Hanke's golden growth rates figured out for most of the major economies. And Canada, even Canada is considered a major economy. The golden growth rate in Canada, by the way, is about 7.2%. And that would allow Canada to hit a 2% inflation target. So the growth rate in Canada is slightly above. It's almost 1 percentage point above, something like that. It's a little above the U.S. Let's say around 7%, David. That would allow Canada to hit its golden growth rate, hit its inflation target of 2%. So that's what I do. You asked what I would do. I'm telling you exactly what I do with precision.
All right. Well, we've talked about monetary policy. Let's talk about fiscal policy for the U.S. The Congressional Budget Office, I believe, for the fiscal year ending September 30th. The CBO projects a budget deficit will reach 5.8% of gross domestic product from fiscal 2022's 5.2%. It projects widening long-term deficits, including 6.4% in 2033 and 10% in 2053. Why is the budget deficit growing at the pace that it is?
Okay, number one, I think the CBO estimate of 5.8% is going to end up being way off, by the way. I think it's going to be about 9 or 10%. It's going to be a shocker, about 9 to 10%. Why? Because of three things. Bidenomics, the Inflation Reduction Act, remember, that's a misnomer if I've ever heard of one. The Inflation Reduction Act. The thing is larded with so many green subsidies, you can't even shake a stick at it. You've got so many. Number two, the U.S. war with Russia. Every day we're piling more money into this war in Ukraine, war against Russia. Canadians are doing the same nonsense. Three, interest charges. We're running a deficit. Yes, the deficit is up. The debt as a percent of GDP, total debt is up. It's about 100% in the United States. And with increased interest rates, the cost of servicing that debt has skyrocketed. The interest costs now are about 10% of the total budget in the United States. So the taxpayer, 10% of the taxes they're paying, they're going for nothing. I mean, they're just going for paying interest.
Let's put it this way. If you were at the head of the Fed, would you cut interest rates today?
I would stop quantitative tightening today and signal that we were not going to have higher interest rates forever, which is their signal, that we were going to, depending on the growth rate of the money supply, we were going to try to do whatever we needed and use whatever mechanisms needed to hit a money supply growth target. Hanke's golden growth rate is 6%, so that we could hit our 2% inflation target. That's what I would do. But the first thing right out of the box that they should do is stop quantitative tightening. Now, the other thing related to this, by the way, is that they're talking about regulations, putting more regulations on banks to increase the capital asset ratios, the capital adequacy of the banks. Mr. Barr, who's the vice governor of the Fed in charge of this kind of stuff, keeps rattling the saber and indicating that they're going to do that. Now that would what? That would reduce the contribution of banks to the growth in the money supply. And already, if we look at the banks are contracting. For the last several months, they actually have contracted credit. Commercial credit in the United States is contracting it at present 0.4% year over year. So that number would even become more negative, which would be bad. That's a tightening of policy, tightening even more than their current tightening. So I would drop all conversation about bank capital adequacy. This is a lot of nonsense anyway. And the Fed, you see, it would be pro-cyclical. We're just going into what I think will be a recession, and this bank capital adequacy, increasing that will just tighten the money supply even more and be pro-cyclical and drive us into even a longer recession.
All right, well, let's move on to the government shutdown that's looming. Moody's has threatened to, I guess, downgrade the country's credit if a shutdown were to occur. What's your take? What's your opinion on this?
Well, it looks to me like we are headed for a shutdown, and the reason for this is this cockamamie way they do budgeting in the United States. Number one, we don't have a Swiss debt break, so we don't have anything that actually is a rule-based system for handling things on the fiscal side. So what they do, they have this debt limit, and then once they hit the debt limit, they just pass these continuing resolutions, emergency funding, and the emergency funding, by the way, they're proposing includes emergency funding for the war in Ukraine.
What's the relationship between the credit worthiness of the nation and a government shutdown? I'm just reading a quote from Moody's here.
This is the government. The government shutdown and the prospect of a credit rating. This is all a credibility thing. So the biggest thing coming out of it, in fact, is a credibility. It's a black eye. Do you want a black eye? Now on the David Lynch show, would you look very good with a black eye? I mean, people would say, "God, how did Lynn get that black eye? What was he doing last night?" You know, that kind of thing.
I would show a picture of the other guy if that were to happen.
Yeah. Well, anyway, you get the message. It doesn't look good.
I understand. So long term, it doesn't have any significant impact on the economy. We've seen this before.
Yes, that's a good way to put it. It probably is going to have de minimis impact in reality on anything except the credibility, and makes makes Washington and the politicians in Washington look foolish and dysfunctional. They can't get anything right.
All right. Last question on the economy, and I do want to talk about the Hanke Gold Sentiment Index, which tracks the sentiment of gold. My question is, Professor Hanke, right, you're predicting a recession by next year, predicting some sort of slowdown. What needs to happen to turn this around? Suppose you were in government and then the president says to you, please design a strategy to avert a recession, construct or engineer a soft landing. What would you do?
It might be, since the causation of the recession is what happened to the money supply a year ago or a year and a half ago. It's kind of hard to undo what you did a year and a half ago. You can't do it. But what you can do is announce that instead of we're going to have interest rates higher forever and all this hawkish talk coming out of the Fed, you say we've finally gotten religion. We're listening to Milton Friedman and Professor Hanke. We're going to adopt and embrace the quantity theory of money, and we're going to get this money supply growing properly. Hanke's golden growth rate of about 6%. So that would help. That would help, because that would mean automatically two things would have to happen. They'd have to stop quantitative tightening, and they'd have to stop threatening to increase the capital adequacy ratios for mid-sized banks. Those would be two things immediately. And they would have to do the third thing, and that is say it is not going to be Fed funds interest rates higher for longer. They will come down once we get this money supply growing at an appropriate rate of around 6% per year. So that's what I would do. And that might be enough for a soft landing. I'm not certain about that, because all the misdeeds that have been done to cause the recession were done with the contraction of the money supply, which occurred a year and a half ago.
So even if we have a reversal of policy, hypothetically today, and we have massive quantitative easing, how can we be sure that this increase in the money supply is going to trickle to the masses and have consumers spend that money instead of having it hoarded by the banks?
Because that's the way this transmission mechanism works, and it's always worked that way since the quantity theory of money came into existence in the 16th century. That's the way it works.
So the government prints money. How does it end up in my pocket, let's say?
Oh, it's very easy. the bank prints money. That's a small part of the money supply. What happens to get money in your pocket? The banks make you a loan. They extend credit to you. And how does that credit get into your pocket? It's credited to your checking account, and checking accounts are the biggest part of the money supply. Right now, they're about 80% of the money supply.
Okay, fair enough. Let's talk about gold. You have a Hanke Economist Gold Sentiment Index. I'll let you give the latest reading of this index, and I do wonder whether or not the sentiment has been shifting at all, given that interest rates are high and given that inflation has been coming down. Traditionally, these are bearish indicators for gold. I'll let you explain.
Well, they are for long term, but short term, the Hanke Economist Gold Sentiment Score is picking up sentiment that every hour. We're measuring this every hour by doing text mining of every article on gold that comes out every hour and grading it. Is it bearish or is it bullish? And for example, a bullish word that would be included if the article included a lot of words like recession, that would give a bearish, a bullish indicator. Recession is a bullish word. A bearish word is something like rate hikes. So we're measuring this every hour. We come up with a sentiment score that ranges from -10 to +10, -10 being an extreme bearish reading, +10 extreme bullish, and we get a sentiment score. And right now, I gave you a dial score from the 28th at 1300 Greenwich Mean Time. It was -4.14. Now, when you get down to that range, that's a relatively bearish signal, and with a 60% probability, we know that will shift around and revert back up to neutral. And what's that mean? That means that if you're short, you want to liquidate your short position and or go long if you don't have a position, and that's the way you would trade it. Now we do have a we do have an algorithm set up to trade off of these scores, and I've also given you how those have been doing. Those algorithms do about 2 or 3 trades a day, so it's trading on very high frequency data. Hourly data is coming in, and in one part of the day you could be long, and the other part of the day you could be short, depending on what those signals are. But the algos, as you see, we've been racking up about, depending on the algo, between 30 and 40% annual rate of return, outperforming massively the outright positions in gold or the S&P for that matter.
Can we invest in this algo? Is this an index we can invest in?
No, you could obtain the algo. First of all, you can get. Let's go back to the basics. You get the signal for $17.95 a month, and you can do whatever you want with the signal. If you want a trading algo, that's something else. Then you have to subscribe to have us manage one of these algos for you, and that's else. And if you want to get any of this, you go to www.thegoldsentimentreport.com. www.thegoldsentimentreport.com. So there's kind of a two-step thing. If you actually want to get the signal and get this thing every hour, and by the way, you get that now. You can get it free on a Telegram account on an app. So you can even sign up to get a modest amount of signals free coming on an app on your iPhone from us, or you can get the real deal for $17.95 a month and get signals. Or if you want to even go further into trading with us, we can set you up with an algo.
Are you planning to do this with any other asset or commodity? Presumably, you could apply the same methodology to anything, right?
Well, yes. The answer to that is yes. And right now we've been for a couple of years, as you know, David. You were one of the early ones that we discussed this with. We have been developing and we're refining and developing the gold market. So right now we are solely focused on the gold market, but theoretically, not theoretically, you could do this as we're doing for other markets, and we plan to do this for other markets. But as they say, one step at a time.
Yeah, I am curious to see how you would integrate this with, let's say, something like cryptocurrencies, where there's a lot of chatter on social media.
Oh yeah,
that would be interesting.
We'd have so much mining to do on cryptos that more than you could shake a stick at.
Probably, yes. Well, where else can we learn from you?
Well, one thing, my Twitter account is fairly significant, as you know, about 662,000 followers, and that's at Steve _Hanke, Hanke. Or if somebody wants to write me and get on my distribution list, they just write me, hanke@jhu.edu. Or alternatively, as I said, go to the www.thegoldsentimentreport.com if you're interested in the Hanke Coffness Gold Sentiment Score and how all that works, how the algos trade it, how their performance has been, and all these things.
All right. Well, we'll put the links down below, and feel free to reach out to Professor Hanke. I'd be curious to see if you get any interesting mail from this, but please do reach out and contact Professor Hanke.
We do. Every time you and I have a chat, we get lots of interesting mail.
Excellent. All right. Well, thank you very much, Professor. Do follow Professor Hanke in the links down below, and I look forward to speaking with you next time, Steve.
Okay, good fishing. I hope the grocery store shelves don't go bare up there in Vancouver on you, but with Trudeau at the helm, you never know.
I have to drive down to Seattle for cheaper groceries. Let's follow up on that next time. The more news to talk about. Thank you very much, and thank you for watching. Don't forget to like this video and subscribe.